Hello, everyone, and welcome to today's panel and presentation. We're going to take about one more minute here for some folks that are just arriving, and then we're going to go ahead and get started. All right, let's go ahead and get started today. I'd like to welcome everyone. Thank you so much for joining us. My name is Matt Anthony. I am with Evident, and I'm going to be moderating our conversation today. We're going to be asking our panel questions at the end. So if you have questions, feel free at any time during the webinar to submit those, and we'll get those. We are going to be recording this presentation, so feel free to access the recorded version after the fact. I'd like to go ahead and introduce our panelists. So we are very proud to have Julie Gaiaschi here, who is the CEO and founder of the Third Party Risk Association. They have a really broad set of challenges there, right? Third party risk has many facets, and Julie's going to talk to us more about that. In her role as CEO of the TPRA, she provides strategic direction for this nonprofit. And the mission is to further the third-party risk profession through knowledge sharing and networking. So hopefully we will do a little bit to contribute to that today. In 2021, Julie was awarded the CEO of the Year by Women in Governance, Risk, and Compliance. So congratulations, Julie. And she's an expert in third-party risk, has led efforts to reduce third-party risk in large banks and healthcare organizations throughout her career. So Julie, very excited to have you here. Dana Thomas is the VP of Operations at Evident. So Dana has been with Evident over 6 years, and prior to that worked at LeaderCast and Motorola Solutions, among others. Dana leads Evident's client service efforts. So this includes onboarding our customers and optimization of their efforts as they work for us. So she has quite a unique view on operational issues of doing insurance verification. And then I'd also like to welcome Nathan Rowe, who is the Chief Product Officer at Evident. He also has a long history with Evident. And prior to that, had been at Air Defense, Motorola Solutions, and others, working in information technology, enterprise software strategy, and product management, and always with a focus on security, networking, and wireless technologies. Nathan is responsible for driving the ongoing product strategy at Evident, and so he has a unique view on the technological challenges of insurance verification. So that's our panel, and we are super excited to have them here with us today. So what we're going to do is we are going to start off by asking Julie to share some of her insights about what are some of the trends and things that are happening in third-party risk these days. So Julie?
Yeah, thank you so much. And I just want to thank you guys for having me on. I really appreciate these types of discussions, and I love learning from everyone, and I'm sure you guys love learning as well. That's why you're on. So I appreciate the opportunity. So I wanted to start by just giving everyone a background on what third-party risk management really is. So in its simplest form, it's the process of identifying and mitigating risk related to third parties. But as you go a little bit deeper, there's way more to that. There's a whole framework that consists of policies and procedures, assessment of controls, oversight of third parties. Basically, you're just working through this whole program to reduce the impact third parties could have on your organization. So the scope of third-party risk management has really expanded in recent years. Third-party risk management was kind of an afterthought in organizations. They thought, well, maybe we need to do something about these third parties, but really it's their responsibility, the risk is, when that is just not the case. So just because you purchase services from a third party does not mean that you have transferred that risk. So I wanted to also talk about really what is included within third-party risk management programs. What's the scope of it? So in its very minimal, simplest form, you have your planning and oversight. So planning of the program, oversight of the program, also planning and oversight of your assessments. Then you have pre-contract due diligence. So that's your evaluation of inherent risk as well as residual risk before the contract signed. Then you have your contracting process, where you're also trying to limit your liability by making sure that you've documented certain expectations, which can also include incorporating insurance requirements in there as well. You have your continuous monitoring. So this is your ongoing monitoring. So once you assess a third party, you're not done. You want to continuously assess them because you're continuously providing them with data. You're continuously asking for their services. They're coming on site regularly. So you want to continuously monitor what they're doing, if there's any changes in process, anything like that, so that you are aware of the risk landscape. And then disengagement is a whole phase of itself. Once that contract terms, your work is still not done. So you have to make sure that they send your data back, that they have destroyed it appropriately, that you've limited their access or removed their access from your building, things like that. And then to top it all off, you have continuous improvement, right? Because risks are evolving. New threats are entering the environment, and you just want to consistently make sure that your program is up to date on the latest trends. So as a part of this due diligence continuous monitoring process, you're continuously evaluating the risk to your organization, and risk isn't just cyber. So that's your strategic risk, financial risk, cybersecurity risk, operational controls. There's many things to consider, and there's new risk domains that are entering the market as well, like environmental social governance. So you're evaluating organizations to make sure that they have good governance structures in place, that they're not doing any kind of like labor forcing people to work, basically. So there's many risks that you need to consider, and once you've evaluated if the controls are in place to mitigate those risks, you can also look to see if there's secondary controls in place that would further mitigate this risk. And a very good secondary control is insurance. So yes, maybe a third party is doing what they say they're doing, but what if something happens? They are still doing what they said they were going to do, but now there's a liability there. So that's why it's important to ensure that you are evaluating certain risk related to insurance. Sorry, the word that was coming to mind was contracts. So related to insurance. So I think this is a very timely discussion. And I really appreciate just giving everyone kind of a general understanding of, what types of insurance there is. So like general liability, what does that really mean? So for example, if you're a retail and some third parties coming in to provide you with certain products or services, and say they damage your building. Well, if they don't have that general liability insurance in place, or it's not sufficient, or it doesn't cover you, or the dates are, past due, then that can really be a risk to you because now you're liable. So really, insurance just assures you that certain potential liabilities are the responsibility of the third party. So with all of that, this is such a great topic, and it really does kind of build itself into what third-party risk management really is.
All right, great. That's a teaser. We'll be hearing more from Julie throughout the presentation. But what we'll do next is, as some people are probably aware, we've recently published a report, The State of Third-Party Insurance Verification. It's the second time that we have published such a report. We did so last year. And this year, based on much of the work from the teams of Dana and Nathan here, we were able to dig a lot deeper. So we're going to highlight some of the things that we found in the report, and then dig in and try to learn as much as we can from those things as possible. So, the report, we're a technology provider, and we are helping companies manage their risk by specifically looking at third parties and other risk-related items that insurance is required on, and then helping them determine where that insurance is in place as it should be and where it isn't. Obviously, this is a very important thing. As Julie mentioned, often there's been an approach in the past that just said, well, there's a contract there, they're required to have it, so we're just going to rely on that, as opposed to actually digging in and verifying it. But we see that the risk is great enough that organizations now feel like it's actually worth the effort for them to do that verification. Once they came to that conclusion, they figured out it's really hard. It is a complicated process, very messy, a lot of manual work, and in many cases, even with significant effort, they couldn't get to a level of really identifying even where the risk was present in their network and not. So we dive into understanding and describing that problem based on what we're seeing with our customers, and how then you can apply that information to reduce your risk. So a couple key terms. So we use the specific term requiring company to mean an organization, it's usually a large enterprise, that has a set of rules for their third parties that say, if you're going to do business with us, then you must have this insurance coverage in place. And that can be a single set of rules for every supplier, or it can be a matrix of coverages depending on the relationship or the type of company. The companies that they're asking to have that coverage, we refer to as insureds, or you'll also hear us use the term third parties. And frequently, certainly the traditional method for demonstrating that coverage was to provide a certificate of insurance, usually generated by a broker or an agent, and oftentimes handled in a very manual fashion, i.e. somebody emails that to you or even mails that to you. And so that is the primary, although we're seeing, an evolution into more digitized forms in some places. And then finally, we talk specifically about verification here. It sounds really obvious, right? Verify. But from our perspective, that's a comprehensive review of the COI or other proof as well, that actually lays out exactly what the requirements are for that insured, and then compares to the actual coverage provided. And I mean, that gets down to coverage types, limits that are required, and then there are a lot of administrative requirements like additional insured, loss payee endorsements, subrogation, that also need to be covered. And if you really need to get to that level of detail to identify where your risk is, and we'll dive into that some more. So key terms for us there. And about the companies in the report, we review more than 40,000 policies per month. We have verified coverage from nearly 1,000 different carriers. And the average number of verifications for the requiring companies in this report was about 1,770. The range actually goes from a few hundred up to in excess of 20,000 third parties being verified. So we see quite a big range, and you can see why when you look at the different industries that are included in the report. So, the retail category is very broad. We have, we work with category leaders in grocery, convenience stores, electronic and technology stores, restaurants. We work with companies in transportation, government, which is an interesting use case we'll talk more about, manufacturing. And then we also added commercial lending on here with a big caveat, which is when we're working with commercial lenders, we're not focused on third parties, we're focused on assets that have a loan against them, and verifying that appropriate insurance is in place for those. And we'll talk a little bit about that special case a little later here. So the key report findings, we've had this finding last year, and it has not changed much in the year since, and it probably won't change in the near future, which is that for the average large enterprise, about 75% of the third parties are not compliant. And we're going to dive into what exactly that means on the next slide. But clearly, if you build a risk model around compliance of third parties, and then you find out that 75% of them are not compliant, that represents a significant risk. And that's a key finding, and it's a key driver for our business. And we work with companies that come in and they're even lower than this, so their compliance rate could be sub 20. And then we have some companies that have done a lot of work in this space and already have their numbers up to, somewhere in the 40s. But that 25% compliance number has held pretty steady here. So what we've been able to do this year is dig into it a little bit more. And so when we look at the top reasons for non-compliance, we see some real obvious things. The first two categories, right, is one, you don't have coverage. And then the second is you have coverage, but you don't have enough coverage. So you don't meet the limit. And those are pretty obvious things. Clearly at that point, additional insurance is going to need to be purchased. Or perhaps, and some would say this means that the process is working, a third party might actually say, you know what, it doesn't make sense for me, that doesn't make sense for our business, so I shouldn't be a third party of yours. But in most cases, it's organizations figuring out that they just need that right coverage. Then we get into things like not having the additional insured listed appropriately, having clerical issues around the insured name, not having the correct carrier ratings, and the details of these aren't as important as the fact that these are fairly straightforward administrative type actions, but any one of which could cause, when an accident or a problem occurs, it could cause a carrier to not provide coverage or follow through on that policy because you're not compliant with their rules around that. And that's a huge risk, right? That means that claims and so on are coming your direction. So at the highest level, the key issues we see for companies, right? And so the point of view here is I'm a new company. I've started working with Evident to try and improve my compliance. And these are the things we find. We find that they have confusing or overcomplicated insurance requirements. So this is the set of rules, and maybe they're not communicated very well, which actually is our next point. Or they conflict in some way. They have things that are very hard to verify. So some things fit very nicely, into an accord form, and then other things do not. And that makes it harder to verify. And then oftentimes it makes it harder for the insured to get it right, because frequently the insured is not an insurance expert and doesn't spend a lot of time on insurance. So there's lots of risk there. The second is, and that leads us to our second point, which is communication. So we find that those organizations that have invested a lot in clarity of communication and frequency and studied how to do that well have higher compliance rates. And so helping people understand that better is important. The third issue we see is perhaps in a case where there are oversimplified requirements or requirements are difficult, we see organizations that have essentially just started granting exceptions very widely. So many of their insureds are actually not meeting the requirements, but somebody has signed off on them and said, yeah, they're fine. That doesn't change your risk model. Your risk model still assume that those folks were covered and they're not. And then finally, even if we get through everything, we figure out where somebody has a gap and so on, we see a lot of folks get stuck at the point of, okay, now I need to actually go get more insurance, or at least delayed, right? Significantly delayed in getting that completed. So that's an opportunity for us as well. So that's really a summary of the key issues. What we're going to do at this point is I'm going to hand it over to Dana, and Dana's going to dig a little deeper here, talk about some of the particular segments, and start to help you understand some of the nitty-gritty of handling these companies and helping them get compliant. Dana?
Yeah, thanks, Matt. As Matt said, there's some key industries that we focused on in the report, and after this session, you'll be able to get access to all the data that we have on these industries. Wanted to point out some key things here, and then we'll dive into 3 specific industries to highlight some examples of the things that are particular to keeping them from having a successful insurance third-party verification program. So a couple areas that came out of the report, just in high-risk segments, you see them on the right there. Today, I'm going to kind of dive into 3 of those. So we're going to talk about government and municipalities, restaurants, and then kind of up a level is just the retail industry in general, which includes grocery. But if you look at some of the risk amounts that are labeled there, when you look at the different limits that are expected across things like general liability, auto, workers' comp, and sometimes property and other coverages, it could really add up just for one third party that you're working with. So the risk is not just, aggregate, which of course grows as you have a number of vendors, but per vendor that you're working with, you can really see some, potential high risk there. So I want to start off by going over retail, and some of the things you'll see in the slide again will be referenced in our white paper on this topic. What we wanted to do is look at across our customers, what are some of the key areas of coverage that are being referenced and need to be verified, and where do we see the most problems? So in the next couple slides that I go over a few of these industries, you'll see on the right-hand side some coverage types and criteria that are listed, and what we found to be some of the most common that are being looked for, how frequently that is being asked across the population of vendors and suppliers, and where that compliance rate falls. So if you kind of just do a quick glance, you'll see that anything in yellow is sort of risky, and anything in red is where there's that high risk. And so, one thing to note as you think about these risks and kind of what you're experiencing in the retail industry, you could just think about how retail has thousands of suppliers to track. A lot of the retailers that we work with, we're talking in the tens of thousands. You're seeing frequent additions and removals of vendors. And again, these can be product suppliers, they can be people who are providing services. And a lot of times you'll have a lot of vendor managers. So these are the relationship managers for these the different vendors, usually those that are kind of controlling a category within retail. And so, it's easy for some of these areas to become non-compliant, as we would say, if there isn't an easy way to monitor sort of the change management, be able to have the visibility and things like that. And it really makes that as an important element to assure that as you're dealing with the volume that retail has, that you're able to easily make changes and keep an eye on where things are at. The second piece that we see as a challenge in retail is, as I just stated, you've got vendors of different types. Of course, you've got product vendors, but with a large grocer that we work with some organic foods and services, they've got people that have lots of different styles of product. And so, of course, the requirements are going to vary across those different suppliers, and you're going to need to be able to handle that. And the one size, fits all is not going to be something that allows you to be successful. And so really making sure that as a retailer, you're able to set different requirements, even across countries of origin or countries that you might be distributing in, or kind of where the retailer is located. It's going to be important that you're able to create what we call coverage groups, which identifies the key requirements that are needed for each different type of vendor. So you're not doing a one size fit all. And lastly, speed. Access to the proof of insurance is important in this industry because it can affect possibly multiple consumers if we're talking about a recall or things like that, and it will impact your potential liability in that process. So the flexibility to visibility and being able to see things of that nature. So you'll see, again, kind of going back to the right-hand side, that one of the biggest challenges for this population is that additional insured, which we highlighted at the larger population. And so making sure that there's a clear way to keep track of that and stay on top of changes is going to be critical with this population. I want to kind of switch gears here and look at restaurant chains. So if you think about this as both your quick service, fast food restaurants and others where you see a lot of franchisee models occurring in this space. And so you begin to see that there are more challenges as you're actually looking towards independent owners who are required to hold insurance for the location or multiple locations that they have. So some of the challenges we see when auto liability is required, we see a lack of that even just being shown, not just not meeting the limit, but that's one area that is tends to have a lot of risk for this space. And then going into some of the property, having business personal property, and a lot of this comes from, again, that franchise model where there might be some elements of the restaurant itself that need to be covered to assure that the overarching brand isn't liable for damage and things that occur there. And then that insured name pops up here. So one thing that we'll commonly see, and this will come across in multiple different industries, is that the individual who's managing the vendors or franchisees are expecting the contract that they've signed with this individual to be under a certain name, and the coverage comes over and it's under a different name. And it's critical that they understand whether or not that coverage is truly representing the person they've entered a contract with, or there might be variance. And that does end up taking a lot of time if kind of individually managed, but it's something that's very important. So when you kind of look across this industry, besides just the challenges from a coverage perspective, you've got the need for great visibility. So multiple owners of compliance review occur. Again, when you're looking at possibly territory leaders for different franchisees, you're going to need to have multiple people accessing the same view of what's going on with these different franchisees, and the ability to do a consistent evaluation. You heard Matt talk about exceptions and things that could occur on a one-off basis. Using something like a single platform will help streamline that process, as well as give visibility across the board to anyone who's being held responsible for assuring that these different franchisees are held accountable for the insurance that they're providing. And then comprehensiveness. We've got building ownership and location, differing requirements based on the restaurant model and form. Making sure that there's the detailed level of criteria that's checked is going to be important. It's often that balance of trying to say, I just have, a few requirements that need to be met, or versus a detailed set, and the possibility that the franchisee is going to meet those requirements, and making sure that you're not really kind of compromising on the requirements that are needed just because they are lengthy. And I know when you're doing something manually, it's easy to kind of move to that compromise because it does take a lot of work, but it is critical and becomes a possible challenge down the line if you aren't considering all the requirements for the particular model. The last industry I wanted to hit on is government and municipalities. Of course, this is an industry where a lot of regulatory requirements are put in place. There's a lot of project-based type work versus sort of maybe a long ongoing relationship. And so again, we're going to see that auto comes into play a lot with the deficiency for this group. When you've got different people working on various projects that have a requirement that includes the need to meet auto liability minimums and different criteria, there's a lot of deficiency that we see in the auto space for this particular industry. Some other challenges that we see are, consistency in the expectations. A lot of times, again, with such a diverse group of vendors and projects going on, it's easy to kind of have things be one-off and handled in an individual contract. And visibility to historical documents for audit proof will come up, not just for regulatory requirements, but also just based on the need to be able to access things from the past if there's a claim or anything that would occur. And so it's important to kind of remove that human bias and get consistent in the entire process, as well as the way that things are recorded. And as I mentioned, that project variety, single vendors can have multiple projects with varying requirements. And those projects can vary across the different vendors, from construction to professional services. So it's really a wide gamut. So being able to relate back the insurance that required per a project becomes critical, so that you know one particular project that someone's working on might require more or less than that same vendor working on a different project, and knowing how to kind of tie that back to make sure that they are consistent, even though those requirements are different for the different projects, becomes a critical thing to be aware of. So those are just some highlights. As I mentioned, we go into a lot more detail, and you can get some more of the detail across the other industries and more on those industries in our white paper. But at this point, I want to turn it over to Nathan. He can talk a little bit about some of the technology challenges that we see with verification.
Yeah, great. Thanks, Dana. So we wanted to make sure that we did cover the technology that enables this, because this is, as you can imagine, and as we've discussed to some extent, is a really sophisticated process. There's a lot of complexity and nuance to it. There's a lot of moving parts associated with it, and there's a lot of details that have to be maintained to really truly understand at a single entity level if they satisfy your requirements or don't. So we kind of think about things in these four terms as far as what's important and what needs to be in place to be able to enable a truly effective verification program. And starting first and foremost with automation. Whether you're reaching out to hundreds or whether you're reaching out to thousands of vendors, just that alone is going to make the need and the time and the energy that you have to put in extremely high if you don't have a way to automate the outreach, the collection, the extraction, the decisioning, the remediation, right? You think about all these steps that have to happen, and you would need a whole team of people to be able to do this, even if you only had a few hundred different third parties that you were going out and you were doing the verification for. So having truly an automation system in place that can automate the end-to-end workflows, take care of all of the different nuance of engagement and all the outreach that has to happen, ends up being extremely important to just be able to stay on top of what is going on, where are you in the life cycle of each verification with each third party, and kind of understand that nuance. And as you can imagine, if you don't have this, being able to drop the ball becomes really, really easy, or being able to get in a position where you're not. Do we lose the slides, or is that just me? Sorry about that. But just getting in that position where you're not following up, you're not understanding where each one is, you're not providing that timely, contextual, relevant outreach and engagement is just going to be a major headwind for any verification program and process that you try to put in place. The next thing that we look at is visibility. So being able to get very granular and very detailed into the different requirements. And as you saw from the slides that Dana covered, these are the top, most notable requirements, but typically our customers have tens of different things that they're going to check per third party. And that means a lot of very granular, very detailed, very nuanced type of data that has to come off to understand where someone is compliant or where they have compliance gaps. And you can think about this from two different perspectives. One is going to be the perspective of you as the admin, you're looking at this, you're trying to understand where you are in the compliance spectrum. You want to understand per third party exactly where those gaps are. So you having that detailed point by point per third party visibility to compliance is extremely critical. But then flip it for your third parties as you engage and you have deficiencies that have been identified. You want to be able to tell them exactly where the gaps are. This is not a case where you're going to be able to say, hey, you're not compliant, and they're going to be able to figure it out. Just the nuance, the amount of details that you get into when you go reach out, when you have that engagement with them, you want to be as specific and pinpointed as possible. So much of this enabled by extracting and digitization of that COI. So COIs come in a lot of different flavors. The information on them is not always consistently coded. And it's very easy to either misread one or have a COI where you misinterpret something because of all the nuance that exists. So being able to take that document that's presented, being able to translate that into a digital form that becomes normalized. So I say normalized, that whether it comes from carrier A, carrier B, or carrier C, whatever brokers are in the middle of that, it all becomes at a point that you're able to view and maintain it in a consistent way independent of the source. That's what we mean by normalization. So once you digitize it, then you put it in a normalized way, then you can go run it through and you can get kind of this detailed view for you as the admin as far as where you have compliance and gaps, and then also your third parties where they are compliant and where they have gaps. Engagement is next. So this is obviously a case where a lot of very good communication happens back and forth. That communication is going to vary. So you're not doing this once a year, right? Your population is not going to have policies that all get onboarded at the exact same instance. Their policies are not going to be coterminous, meaning they're not all going to expire and be renewed at the same point in time. So, if you look at this, you're going to be constantly having some amount of reach out and response and engagement from your population over a 12-month period. So you need to make sure that you're going out and you're reaching out and you're touching them at the point that you need action from them. And you're doing it in a way that you're being very direct and clear of what's being asked of them. And one thing that we found over and over again is that oftentimes these third parties that you're engaging with, they're not insurance experts. They don't know every nuance when you list out the set of requirements, what that means. And they're often not even in a position to take a COI and evaluate it if it meets the requirements that you've got. So to some extent, they're relying on their brokers, their insurance brokers, or agents to provide a COI in a way that's compliant. So what this really means is that there's a lot of burden on that communication to be clear and crisp in what's needed when you give that email out to them to say, hey, we're starting this compliance program. We have to go meet these certain set of requirements. Provide it to them in a way that they can either directly send it to their broker or they can copy and paste if they're not going to just go ahead and forward it. So they have the requirements. In this case, we've also found sometimes providing a copy of a fake COI, so you kind of make up a company and you pre-populate it the way you want, is often very helpful because it removes some of the ambiguity. I kind of know what it needs to look like. And then the broker is able to turn that around with a higher success rate and make sure it gets populated the way that it needs to be. Or if there's gaps and you're reaching out, again, on the engagement thread, you're being very pointed, very surgical to say, hey, great, you've met these 43 other requirements, but this 44th one is where you have the gap. Here's what it is, and calling it out very directly, very specifically. And that makes sure it gives the team on the other side, your third party, what they need to know they have to go comply with it. And then configurability. So the kind of the last, but certainly not least. So we see a great deal of variability. So, the kind of three that we looked at in the broader set of verticals that we focus on, we see a great deal of variability in the individual requirements of third parties. So, we have customers that have, on one extreme, everyone's consistent, and everyone kind of has to have the same set of requirements, right? That's, more common in kind of a franchisee type model where, there's a base set of requirements and maybe there's one or two things that could change. And then on the other extreme, we have customers that have tens of different groups of really risk categories that they've defined, depending on the risk that they're exposed to, that they go and they translate like the risk that they're trying to protect against into the different groups. So you have to have the ability to configure a program that's going to be able to accommodate whatever degree, wherever you are on that spectrum of variability that may exist, and make sure that you're dialing it in where when you reach out, when you do the automation, when you do the engagement, when you get the visibility, that you're doing it in a way that's targeted for the risk that's expected from that third party. So, there's kind of two sides of this. You don't want to ask for less coverage and protection than you need because, you're basically saying, I'm going to go for the lowest common denominator. You're probably going to be undercovered in that case from these third parties. On the other side, you don't want to go all the way on the top of that and make sure that you're asking for the top set of requirements because you're going to have a very high number of these third parties that aren't applicable because it doesn't apply to them. They're going to have requirements that get set to them that they either commercially are not suitable for the relationship that you have, or they require things that just aren't applicable because they don't interact or expose you to a certain type of risk. So you have kind of a great degree of this variability that exists. And you need to be able to configure a system and have the technology where you can set up the risk profiles, the risk groups that exist in a way that you're evaluating down to the individual vendor the exact things that are applicable to them. And we even can get deeper than that if you want to get all the way down to an individual entity. We could take it to that extreme, as we've had some cases do. But it's really about taking that great deal of variability and being able to basically set a program for it, right? Establish what the rules are, and then everyone gets placed in a bucket. And now you're evaluating unique risk to that unique third party. And you have a much more successful rate of compliance because everyone kind of knows and understands why they're being evaluated the way that they are. Really helps them. And then just to wrap up here, I think as we look at this and we kind of look at how we've taken technology and we've applied it to this program, it's really big, complex, a lot of dynamic, a lot of moving parts, a lot of touch points type of issue. We've been able to see dramatic, very material changes in compliance rates for our requiring companies that work with us as they look over that first 6-month type of period. Typically, more than doubling their compliance rates, which is just significant. They've been struggling with this for a long time. Whether they're doing it internally, whether they're using kind of another option, and then they bring our solution in, and because of that automation, they're doubling their compliance rates, but also reducing the amount of time and energy they themselves are having to put into the program. So it really helps them become much more efficient, much more effective at being able to get kind of that compliance rate much higher than they've been able to see it before, and again with less effort. And with that, we are going to go to a Q&A session. So if you have any questions that have come up, just a reminder that you'll be able to put them in to the Q&A section. And it does look like we've got a number, but keep putting them in, and our moderators will make sure they get promoted. And that we as a team will go over and try to answer as many as we can.
All right, thanks, Nathan. So we're going to jump in here. So one is more of a, but I think a pretty helpful one from when Julie was speaking, saying, I can verify Julie's statement since I have served as a consultant and expert witness on cases ranging from a few $1 million to over $200 million where the insurance was not compliant with the contract specs. So thank you for that comment. That sounds scary. So next question, very simple. Where can I find these slides, please? So you'll have a webinar archive, so that includes all the slides. The other thing is under the attachments tab, you should be able to download the actual report now. If you don't get that and you need a way to get it, then come on over to our website at evidentid.com, and we will provide you a free copy of that report. We have a question here for Julie. What is the impact to organization should a third party not provide sufficient insurance coverage? So I think kind of a real high level view of that. Julie?
Yeah, that's a great question. And in order to answer that, you really need to step back and look at your own organization. And I saw a bunch of questions coming in about how do I get my insurance requirements? How do I know what those are? And that all deals with kind of what Nathan was talking about, where you're looking at your organization's risk appetite. So looking at all your assets, looking at what you do, looking at what's important to you. So based on what's important to you, then you need to start evaluating, okay, I have data that's important to me. I have stores that are important to me. I do participate in some type of transportation, either someone's coming to deliver something or I have cars where people are using. So it just really depends on the business that you're in. And then evaluating, do any third parties help with any of these processes? So maybe you have a vendor that helps deliver things. Maybe you have a contractor that comes in and works on your HVAC. Maybe you send vendors data. Because there's now cyber insurance. So it really depends on the type of business you're in and what third parties are helping you do. And then I would look at what's the risk to your organ, like what is the impact that these organizations could have on your business if something were to go wrong. Could it result in a breach? Could it result in property being damaged? Could it result in products or services not getting delivered to you? That is what you want to protect against. So when Nathan talked about putting things in buckets, maybe you have a bucket for your transportation third parties. Maybe you have a bucket for your vendors that host your data. So kind of figuring out what those buckets are, and then working with your insurance providers to then determine, okay, for this bucket, what type of insurance do we need, or does that vendor need? So it might be general liability or workers' comp or commercial property or cyber insurance, which is actually growing and increasing in relevance, obviously, because of all the ransomware going on. So then looking at that, and that is where you're starting to build out your requirements. Now, after you get those requirements and after you are working to validate if your third parties have the type of insurance that they say they're going to have, which hopefully you've documented in a contract, not only the type of insurance they should have, but also the levels they need to have, then we're talking about impact, what's the impact to your organization if they don't have that insurance? Look at the news. So what is happening within the news? People are getting ransomware attacks. People, things are happening to their property. That's the impact. If they don't have correct insurance coverage, or they have the dates wrong, or they don't list you as an insured, you will be liable, or you'll have to settle in court instead of trying to work through an insurance organization. So having sufficient insurance, having your third parties have sufficient insurance, and making sure that they have that insurance is pretty critical, especially given the industry you're in. So if you're highly regulated, or you have a lot of customer data, or you have a lot of buildings to protect, it could be at a high cost to your organization if you don't validate appropriately. That was a long-winded answer.
That's great. It was a tip of the iceberg kind of question. So that
Yeah.
makes sense. So I'm actually going to follow on with one here. Actually, I'm going to kind of mash up a couple that are related. I have a high degree of variance in my insurance compliance requirements. How do you manage each supplier needing a different requirement set? And the other question, how many sets of requirements is reasonable? So Dana, you might be able to take a crack at this one.
Yeah, I think, as far as the variability goes, there's the possibility when using a platform like ours to easily set up those sets of risk requirements so that you're not having to manage and remember them independently, but rather you can basically create risk codes or risk profiles that you're going to measure that against, and make sure that you're, kind of aligning that. And then Matt, remind me the second part of the question. Just
how many sets of requirements is reasonable?
Yeah, I think that as Matt said, it can be anything from, most of our customers probably have around, 3 to 5, but we do have one customer that has 52. And that's because that's what they need. They actually have quite a wide variety of different types of suppliers. We've got different countries that they have things coming from. And so with, tens of thousands of vendors. And so I think really it's not necessarily a number that's the right number. It's really about what are those profiles and categories that you are that you need for your type of business, and making sure that you kind of think of it that way.
Okay, great. And we got another one from an audience member who obviously was prompted by what you guys were speaking about. What are your thoughts about having low risk or maybe even moderate risk vendors provide compliant COIs, but approve without all the support endorsements, such as actual AI endorsements, waiver of sub-endorsement, primary contributory endorsement, etc., also on hand? And I'm happy to repeat that one for you. What are your thoughts about having low risk or maybe even moderate risk vendors provide compliant COIs, but approve without all the support endorsements, is in short. So Dana or Nathan, you guys want to add something to that?
Yeah, I mean, I'm happy to take a swing. I mean, from our perspective, this is a risk conversation, right? Risk is not binary. You're not either zero risk or all the risk. So I think it's a decision that has to be made. In general, we would recommend taking an approach that's more consistent. Because what we do see is a lot of movement in the groups as businesses grow and evolve over change, right? Whether there's suppliers, vendors, some sort of maintenance type activity that's going on. That can change, and taking a consistent approach obviously makes it easier for you to manage overall. And honestly, like the ability for these third parties to add the endorsements typically isn't that big of a deal. So, whether you're trying to bucket it out, in one way to achieve a higher compliance rate, generally we wouldn't necessarily see that. So I feel like there's a lot of nuance in here in the question. So we're happy to take on kind of more specifics if needed, but I think keeping it consistent, keeping it simple is always our recommendation. And that way you're not having to kind of worry, did you put someone in the wrong bucket, or if they move buckets, they've got to go back and do something else. You have it. It's no more work on you to do it. And it doesn't cause a third party a lot of effort either, so long as you're clear on that communication of what's needed. Their brokers are more than adept to be able to come out and turn around and provide the answers here that are needed to prove compliance, which is much better than assuming that it's there, and then when you realize that there's a loss at hand, finding out the reality that it's actually not.
Yeah, I think I just want to piggyback off what Nathan said. I think the key to this is definitely communication. I can maybe read a little bit into the question and say that with having those requirements, it might, seem like extra effort on both ends, the third party as well as the organization to, kind of check those things. But what we've seen, and, we've worked with companies to adjust this, is the key thing is just having that clear communication, possibly using a sample COI with sample endorsements as what you're sharing with that vendor to make it really clear what is required of them, so that you get that back, and then it becomes a lot easier. So I think it's a little less about what the requirements are, assuming those requirements match the vendor and the actions and the things that they're going to be performing, or kind of their engagement with you, and a lot more about, are you clear in what you're asking for? Is that something that they'll understand they need to get back to you, so that you're not deficient in anywhere, but you're getting back what you expect.
And then we had one more comment from the audience. I've seen so many so-called low-risk vendors result in major uncovered losses due to not verifying the coverage requirements. So just a little cautionary note there. All right, let's see if we can get one or two more questions in here. It's great stuff. How do I make sure that each insurance COI addresses the vendor requirements completely? Dana, do you want to talk about this one? You live and breathe this every day.
Yeah, I think some of this comes back to, as we know, I feel like there's a lot of variance in understanding of insurance on all the different parties involved. So whoever is running your verification program or doing the risk management, they probably have one level of understanding. Clearly, when you're working with a vendor, you're probably not working with the person who is the most knowledgeable, or there's not a knowledgeable person in insurance there. And then you play a game of telephone, right, to try to get the broker the information they need to provide the right details. So what we found to be, again, most successful is putting together sort of that mock COI, or something that is almost like a way to translate that communication chain, so that what the expectation is. And starting off on your side, if you need to have internal people review, or perhaps your own insurance broker, given that clearly if there's deficiencies on the vendor side, that's going to fall back on your insurance. Making sure it's very clear what that requirement is. And once you kind of have that mock, example, that sample, as you get things in, it's going to be a lot clearer to match that up. Of course, again, insurance is not 100% cookie cutter, and we don't always get the COIs over from the brokers that have the information right in the right spot, but it does create a good starting point. So at least you're kind of at that 80-20 rule or 90-10 rule, versus starting with just kind of a widespread variance in what you receive back when asking for certain requirements.
I think one thing to add, Dana, just on that, just as a really simple way to remember this, like assume that the third parties know absolutely nothing about insurance, right? You have to get as simple and direct as possible and equip them to take some text, some language, some document, whatever it is, and send it to their broker, right? Like that's got to be your lowest common denominator, because reality is most of them do not, right? They understand they pay a premium yearly, and they understand they have like a limit and maybe there's a certificate holder, but they don't go a lot deeper than that. So just as you get into nuanced requirements, just understand that your lowest common denominator doesn't have a lot of knowledge or background or insight into insurance, and you'll have to make it amazingly easy for them to translate that or convey those needs to their broker so they can get a properly generated proof of insurance document.
All right. Thank you, everyone. So thanks to our audience, we've had a lot of great questions and comments put in. We did have one more, which is there's some sort of demo of the reports or interaction that's going to be shown. So not on this webinar, but certainly we can arrange to do that for you if you would like to reach out to us here at Evident. And other than that, like I said, we've gotten so many good questions and comments that we might just have already teed up the next webinar that we're going to do and dig into some of this stuff further. So I want to thank everybody for their time. I certainly want to thank Julie, Dana, and Nathan for sharing their expertise with us today. And other than that, again, thank you everyone for attending, and have a great rest of your week.
Thank you.